I want to talk to you about tax deductions that you're not taking right now that you should be taking, okay? So the first one is charity. And the thing here is that when we talk about charity, everybody knows that you can deduct charitable contributions, but not work you do for charity. So did you know that you can deduct the cost of transportation to a charitable event, for instance? So if you're heading to a fundraiser right now, keep track of your mileage and deduct it come tax time. This is really important. So you also have out-of-pocket charitable contributions. So it's hard to overlook the big charitable gifts you made during the year by check or payroll deduction. That's totally accounted for. But the little things, those little things add up too. And you can write off out-of-pocket costs you incur while doing good deeds. So ingredients for casseroles you regularly prepare for a qualified nonprofit organization's soup kitchen, for example, or let's say the cost of stamps you buy for your school's fundraiser, those count as a charitable contributions as well. So, and the cool thing is, if you drove your car for charity in 2023, remember to actually deduct 14 cents per mile, 14 cents. So this is pretty, again, those little things, they do add up. And the second charity that the second deduction that you're not taking is actually related to home office. So the self-employed are eligible for a variety of tax deductions that other workers are not. So for instance, they can deduct a portion of the cost of utilities, or let's say even rent for their home office, as well as magazines they subscribe to or member organizations in their career field. So the whole thing here is that you have those so home office related expenses are kind of cool, because you just need to make sure that that the paper trail has to be there. So you got to be able to back everything up. So if you take home office related deductions, be ready, because if you are audited, you need to have the proper substantiation to really tell the IRS, listen, everything is legit, everything is for real, and I did incur those costs. So do not just make stuff up. Okay. So the first two tax deductions that you're not taking. First one, charity, and second one, home office related deductions. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. The third tax deduction that you're not taking relates to disaster recovery. So let's say if your home was struck by a natural disaster for which federal aid was issued, you could be really eligible to deduct uninsured costs you paid in getting your life back together. So it's one of those things where if something unfortunately were to happen to you that is weather related, make sure that you actually keep track of everything, because you will be able to deduct part of it or even all of it, all of those costs come tax time. Number 4, saving and saving and saving and saving. So let's say refinancing your mortgage. This is a great decision, not only financially, but it could also pay off in more ways than one. You will save each month on the interest for your home loan, that's for sure, and you can deduct any loan points you pay on the refinance. So it's one of those things where a lot of taxpayers forget about the refinancing aspect of things. So there are tax advantages that you can actually avail yourself of this year or even next year. Okay. Also, number 5, the price of health. So what happens here is that you can deduct the cost of medical insurance premiums that actually surpass 10% of your adjusted gross income. Remember that number, 10% of your adjusted gross income, even if you are covered in an employer plan. So for those who are self-employed, the 10% threshold for health insurance premiums is removed. So this is kind of cool in terms of, getting your back together, or even sort of stabilizing your finances. This is really good. So number 3, disaster recovery. Number 4, saving and saving and saving, especially when it comes to refinancing your mortgage. And again, it's one of those things where a lot of folks think that the tax advantages are only inherent in a home equity line of credit. No, it also happens if you are doing a refinance. Now, before you do the refinance, though, just make sure that the new interest rates compared to the old interest rates make sense after you calculate all the points that really are inherent or pertinent to the refinancing program. And number 5, your health premium. So don't forget to claim those as well. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about the top tax deductions that you're not taking, that you should be taking. Next, you have teacher appreciation. And what I mean by that is that, educators, including K-12 teachers, teacher aides, instructors, or principals can get an above-the-line tax deduction for materials they buy for use in classrooms. Because it is an above-the-line deduction, itemizing isn't really required for this deduction. So when I talk about educators, I'm talking about online coaches as well. So real-life coaching real-life coaches or online coaches all really they really qualify here. So this is really fantastic. One thing I want to say here is that you also want to so you want to validate this by your state tax authorities, because this sort of a deduction is not available in all 50 states. Some states do allow it. So if you are an educator, you can qualify federally, but also state-wise for this particular deduction. But some states actually don't have it on the books. So please double check with your state tax authorities to have a clear idea what we're talking about here. And number 7, you have financial planning. So keeping your finances healthy also could lend you a healthy tax deduction. So tax planning and investment expenses can be deducted if you itemize and the cost exceeds 2% of your adjusted gross income. And the cool thing here is that investment expenses could actually include phone calls to your broker or even subscriptions to financial publications like Forbes and Fortune. And even if you drove to your broker, for instance, this could also could qualify when it comes to financial planning expenses. Another tax deduction that you're not taking is actually revolves around working parents. So parents who work and leave their children with a caregiver are eligible for a tax credit to offset the cost of a babysitter, daycare, nursery school, or preschool. And of course, there are limitations on the credit, but those limitations include the age of the child and the percentage of the credit. But overall, the credit is there, so you can actually avail yourself of it. And the cool thing is that when we talk about the credit, a credit actually reduces the tax bill that you have to pay, whereas a deduction just reduces your the amount on which tax should be calculated. So a tax credit is way better in some cases, if not most cases. Let's talk about the deductions that you're not taking around moving. Okay, so making a move. So if you're lucky enough to find a new job, that's really cool. But if sometimes you might be bummed that it isn't in the next states, you can actually deduct what you spend packing and moving your belongings, as well as some costs for storage, insurance, transportation, and lodging associated with the move. So the cool thing is that there is no limit to the deduction, but your new job must be at least 50 miles farther from your home than your old job. Okay, and so moving expenses, this is kind of cool. So, and the thing is that in honor of our nation's military personnel, all enlisted active duty and reserve military can file free federal and state taxes that relates to their moving, for example. And so we're talking about what? We're talking about all kinds of military tax situations, including military and civilian income, including combat pay, BAS and BAH, military-related expenses. And you also, if you completed a PCS, basically a lot of tax preparers, our tax preparation software, are they will work with you to make sure that you file your taxes easily. So I'm talking about TurboTax, I'm talking about H&R Block, I'm talking about Tax Layer, I'm talking about Tax Act, and so on and so forth, Jackson Hewitt, and so on and so forth. Another top tax deduction that you're not taking right now revolves around you working 9 to 5 and then some. So for most people, the costs they incur heading to and from work every day are not deductible. For part-time workers, however, if you work, let's say, 2 jobs, you can deduct a portion of the cost of getting from one job to another. Okay, but the thing is that just make sure that it has to be work related, and so those employment costs have to be tracked. You have to have the proper paperwork. So just make sure if you're driving, just make sure that you actually record the mileage through an app, for instance, because come year end, those are areas where you can actually save some cash. Okay, so working 9 to 5 and then some is actually, it has a lot of expenses that you should be taking, a lot of deduction that you should be taking right now. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about the top tax deductions that you're not taking right now that you should be taking anyway. Another interesting thing that what we love about tax deductions that you're not taking right now is that it really revolves around a diversity of areas. For example, state sales taxes. So this write-off makes sense primarily for those who live in states that do not impose an income tax. So we're looking at you, Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. So here is why this is a factor. You must choose between deducting state and local income taxes or state and local sales taxes. So for most citizens of income taxing states, the state and local income tax deduction is usually the better deal. When you calculate everything, it is the better deal. For those of you in an income tax-free state, there are two ways to claim the sales tax deduction on your tax return. One, you can use the IRS tables provided for your state to determine what you can deduct. In addition, if you purchased a vehicle, boat, airplane, home, or did, let's say, major home renovations, you may be able to add the state sales tax you pay on those big ticket items to the amount shown in the IRS tables up to the limit of your state. So, or two, you can keep track of all the sales tax you paid throughout the year and use that. So it's one of those things where you have to really see what really works for you. The best way in our analysis is to really see what you can deduct by using IRS's sales tax calculator. Now, keep in mind though that the total of your itemized deductions for all of your states and local taxes is limited to actually $10,000 per year. Let's also talk about reinvested dividends. So this is not really a tax deduction, but it is a subtraction that can save you a lot of cash, and it's one that many taxpayers miss. So if, like most investors, you have mutual fund and stock dividends automatically reinvested in extra shares, remember that each reinvestment increases your tax basis in the stock or mutual fund, and that in turn reduces the amount of taxable capital gain or increases the tax saving loss when you sell your shares. So this is kind of cool in terms of reinvested dividends. So fantastic. Another interesting one that you need to think about, tax deductions that you're not taking, student loan interest paid by you or someone else. So in the past, if parents or someone else paid back a student loan incurred by a student, no one got a break, right? So to get a deduction, the law said that you had to be both liable for the debt and actually pay yourself. But now there is an exception. You may know that you might be able to take a deduction, but even if someone else pays back the loan, the IRS treats this as though they gave you the money and then you pay the debt yourself. So a student who's not claimed as a dependent can qualify to deduct up to $2,500 of student loan interest paid by you or by someone else. Another one is that you have a child and dependent care credit. So a tax credit is so much better than a tax deduction. That's what I said earlier, because it reduces your tax bill dollar for dollar. So missing one is even more painful than missing a deduction that simply reduces the amount of income that's subject to tax. So, but it's very easy to overlook the child and dependent care credit if you pay your child care bills through a reimbursement account at work. So for this year, 2023, the law allows you to run up to $5,000 of such expenses through a tax-favored reimbursement account at work. Up to $6,000 in care expenses can qualify for the credit, but the $5,000 from a tax-favored account cannot be used. So if you run the maximum $5,000 through a plan at work but spend more for work-related childcare, you can claim the credit on up to an extra $1,000. That would cut your tax bill by at least $200 using the minimum 20% of the expenses. And the cool thing here is that the credit percentage goes up for lower income households. Okay, so this is really cool. And so when we talk about this child and dependent care credit, you have to understand that you have to qualify for this credit depending on your income too, though. So it's important. And one thing I want to say here is that it's one of those things where it's a lot better if you have let's say like two or more children, and also if you and your partner are filing, like if you're filing jointly. So if you're filing jointly, you can actually sort of combine all the advantages to actually, qualify for the credit a lot more. So this is really, really fantastic. Next, you have the Earned Income Tax Credit. So millions of lower income people take this credit every year. However, 25% of taxpayers who are eligible for the Earned Income Tax Credit fail to claim it, according to the IRS. So some people miss out on the credit because the rules can be complicated. So others simply are not aware that they qualify. So the EITC is a refundable tax credit, not a deduction, with maximum amounts for different filing statuses ranging from $560 to $7,430 for 2023. The credit is actually designed to supplement wages for low to moderate income workers, but the credit doesn't just apply to lower income people. Tens of millions of individuals and families previously classified as middle class, including many white-collar workers, are now considered low income because they lost a job, they took a pay cut, or they worked fewer hours during the year. So the exact refund you receive depends on your income, marital status, and family size. So to get a refund from the EITC, you must file a return, even if you don't owe any taxes. Moreover, if you are eligible to claim the credit in the past but didn't, you can file anytime during the year to claim an EITC refund for up to 3 previous tax years. You also have a state tax you paid last spring. So it's one of those things where you can actually deduct that on your taxes as well. Not a problem. And the maximum is 10 grand a year. And you also have refinancing mortgage points. So when you refinance a house, that I think I said it earlier, but I was talking about the home equity line of credit here. Those points also qualify you, not a problem. You also have a jury pay paid to an employer. So some employers continue to pay employees full salary while they are doing their civic duty, but ask that they turn over their jury fees to the company. So the only problem is that you have to report those fees as taxable income. If you give the money to your employer, you can deduct the amount, so you're not taxed on money that simply passes through your hands. Okay, so it's one of those things where if this arrangement happens in your company, just make sure that you report it throughout the year. Bottom line here is that you have a lot of small areas where you can actually save a lot of cash by taking like the unheard of tax deductions. I hope that this comprehensive list of 18 tax deductions that you're not taking really help you out, so you'll be able to get a fatter refund this year. And by actually looking in granularity to those areas where you could actually save some cash. Okay, so this is really fantastic. Thank you so much for your attention. I really appreciate it. In today's conversation, I gave you the top tax deductions that you're not taking that you should be taking. Okay, very important. God bless you. I'll see you next time. But until then, remember, stay marvelous.